A fixed interest rate is an interest rate that stays the same for the entire loan or credit period. This means your monthly payments remain consistent, making it easier to budget and plan for the future. Fixed rates are commonly used in mortgages, personal loans, and auto loans. The biggest advantage of a fixed interest rate is stability. You know exactly how much you'll pay every month, no surprises. This makes it ideal for people who want predictable payments and protection from rising interest rates. However, fixed rates often start higher than variable rates, meaning you might pay more in interest in the short term. A variable interest rate, on the other hand, changes over time based on market conditions. These rates are typically tied to a financial benchmark, like the prime rate or LIBOR, and can go up or down depending on economic trends. Variable rates are often lower than fixed rates at the beginning, making them attractive for borrowers looking to save money early on. However, they come with uncertainty. If interest rates rise, your payments can increase, making it harder to budget. Variable rates are commonly found in adjustable-rate mortgages, credit lines, and some student loans. They work well for people who are comfortable with some risk and believe interest rates will stay low or decrease over time. Now, let's compare them side by side. First, predictability. A fixed interest rate gives you consistent payments, while a variable rate can change unexpectedly. If you prefer stability and long-term planning, fixed rates are the better choice. Next, let's talk about cost. Variable rates often start lower than fixed rates, meaning you could save money in the short term. But if rates rise, your payments could go up, making the loan more expensive. Fixed rates may cost more at first, but protect you from future rate hikes. If you want to minimize immediate costs and can handle fluctuations, a variable rate might work. But if you want long-term savings and security, a fixed rate is better. What about risk? With a fixed rate, there's no risk of your payments increasing, so it's a safer option, especially for long-term loans like mortgages. A variable rate, however, carries the risk of higher payments if interest rates rise. If you're financially stable and can handle some uncertainty, a variable rate could save you money. But if you want peace of mind, a fixed rate is the safer option. Now, let's consider flexibility. Some variable rate loans allow you to take advantage of lower payments when rates drop, making them useful if you expect to pay off the loan quickly. Fixed rates, while predictable, don't offer this flexibility. If you plan to repay your loan quickly or refinance, a variable rate could be beneficial. But for long-term loans, a fixed rate is usually the smarter choice. Finally, let's talk about when each is best. A fixed rate is ideal for long-term loans, large purchases, and people who prefer financial stability. A variable rate is better for short-term borrowing, people who expect interest rates to drop, or those willing to take on some risk to potentially save money. So which is the better choice? If you value stability, predictable payments, and long-term security, a fixed interest rate is the way to go. But if you're comfortable with some risk and want to take advantage of potentially lower costs, a variable interest rate could work for you. The right choice depends on your financial situation, risk tolerance, and how long you plan to keep the loan.